Okay, hello everyone, and welcome to this part, module 6 of the price ladder course. Where in this module things get a lot more interesting, and I think the learning curve, um, it did get quite steep from module 3, module 4 onwards. Sorry, I've had a pretty long day uh, at work, so do excuse me if I sound a little bit tired. But so module 6, we're going to be looking at um, few text price ladder setups. So now we're actually getting into the actual setups, the meat. The first 50% of the course, we've gone through, built the foundation, showed you guys the very, very basics of the price ladder. And this is where we're going to start putting that knowledge into action. Before we start putting that knowledge to action, we have to start building a small foundation around um, uh, giving a little bit of a simple model behind the market. Also introducing a volume volatility matrix. So to actually look at the setups, this kind of setups we're going to be looking at in each of the market conditions. Because I'll tell you right now, in just from the time that I've spent in the market since I started, it does take you a while to actually learn when to trade and when not to trade. If the market conditions are changing, how should you change accordingly? Now, if you can realize this quicker than others, you're going to save yourself a lot of money because um, the volume in the market changes, the liquidity in the market changes, the volatility in the market changes. The market's constantly adapting and evolving. If you're not adapting with it, you will get burned. So the very first part of module 6. In module 6, we're mostly looking at fading setups, which I'll go through in the second part of module 6. But the first part of module 6, I actually want to open up by building a bit of a structure behind things so you guys can understand um, more or less the kind of way we look at markets here at Futex and how I've been looking at things for a while since I started my trading career. So first thing we're going to go through is called volume volatility matrix. So what we actually want to cover with the volume volatility matrix is basically just show the various conditions and how we can trade in each one. So if we were to draw a very simple chart here, so we went basically something like this. We had this axis here, and then another axis at the bottom. Try and make that big so we have enough space to write. And then in the center, I'm going to give ourselves right here. And then draw across here. So what we want to do here, we've got, here we've got high volatility. And here we have low volatility. This is also low volatility. And also on this side of the spectrum, so on the x-axis is low volume. So low volume, low volatility. So low volatility, low volume, high volatility, and high volume. So if we're looking at certain markets and certain conditions, we want to understand what the players are in the market that trade. So which market participants are most active in each type of market, and what strategies to use, and what conditions you usually find these kind of markets in. So if we start off just from a very low volume, low volatility. So we start off in this little quadrant here and start building off of that. So the low volume, low volatility part, usually you find these on bank holidays. So usually bank holidays or just before big event. big event risk. So, for example, the day before on non-farm payrolls, the day before a massive ECB event, the market's kind of squaring off. But if it's kind of found its value and it doesn't have any more pricing to do in, it usually just doesn't do much. Very little volume, very little volatility. And you want to understand what goes on in these kind of markets. So usually in these kind of markets, number one, so the first facet that we notice is this is the kind of market we find it in. The players that we find are, it's usually algos. Algos rule the market in this type of market. And the price action is choppy. So very choppy price action. It goes bid and offer very easily. There's very little in the market. So you can see it just going bid and offer quite easily. And there's really no liquidity. So if you are stuck in a position, you don't really want, you could go offside quite quickly. You don't really know where you're wrong. It's difficult to ascertain the price action if there's no flow in the market. So it's actually quite a difficult market to trade in, at least for myself. Some people do very well in these kind of markets. It's not my particular type of market, not my edge. So really, what are the types of strategies that we want to employ in this type of market? Well, if you're good at flipping, this could be a good environment because usually we get a lot of flipping action, algorithmic trading action. So that's a good type of, you know, uh, strategy to employ in this kind of market. I usually, if I see good levels or good areas that I want to get involved in, I don't like to read the price action too much because if there's no volume, there isn't anything to read. So the price action actually becomes null and void. In these kind of situations, you don't want to be reading too much into what's happening on the price ladder unless you see a specific algorithm or something that you understand. So usually I just tend to position trade. Put in my entry, put in my target, put in my stop, and I just let it go. I don't like to play too much around with it. So if we move on to, let's just move on to, let's say, a high volume, low volatility scenario. So in a high volume, low volatility scenario in this quadrant here, well, in these kind of scenarios, the market's often trading within larger time frame acceptable value. So in an area where it's accepted value. So what we'll put here is market often trading within larger or longer term acceptable. And what you'll find is on these kind of days, very low volume, low volatility, but high volume. A lot of the times you actually see quite nice range days. The market's ranging, not necessarily a perfect bell-shaped distribution, but at the end of the day, you'll actually see that it's quite, quite quite a distributed normal distribution. So, we'll have something along the lines of this. That's very bad. I actually have to draw that again. Just bear with me. So, but you understand what I mean when I say a normal distribution. So, if anyone that's done statistics, it's a very basic bell-shaped curve. So, what I'm drawing is essentially something like this, like that. These are your outlier areas at the top, and the majority of the trade takes place in the center. And that's usually what you'll find on these low volatility but high volume days. You'll have these kind of range days. They don't necessarily look like that from the get-go, but you'll have maybe a move up. You won't find any sort of buyers there. They'll kind of drift off and find a low and then sort of range in the middle for the rest of the day. So that's kind of what you'll find on these kind of days. And really, the market participants that are usually in these kind of markets, you'll get a lot of locals like myself, and market makers within the range. So a lot of, these guys are within the range, facilitating trade, and there's enough liquidity for you to trade. And, in that kind of situation, when you've got enough liquidity and you could trade that, that's a good situation, a good scenario for you to scalp. So from a strat perspective, you want to scalp. And again, you could also position trade. So that's the kind of ideal I have in my head when it comes to these kind of days. When I start seeing not too much volatility, I've got good liquidity, I might want to scalp. When it's liquidity, low liquidity and low volatility, I'm not really looking to scalp because it's quite difficult to get in and out of positions. There's no liquidity, there's not enough on the bid and offer to get out of. So it's quite difficult in those situations. So scalping, it's actually good to have good enough liquidity. Because in low volatility, low volume days, sometimes you'll have like a bid and offer spread, which you don't want. And if you're trading in a thick enough market, that's where you can scalp, well. If we move over to the more interesting, I'd say for me, probably the most profitable scenario is a high volatility, high volume market. Now, what's happening in these kind of markets? Because these markets are very interesting. This is when you usually see the market is broken outside of larger time frame acceptable value. So if this is our acceptable value, in this scenario is, likely the market's broken out of this, and anyone that's positioned in this area has to kind of give up on their positions, and that's where you start seeing a little bit of volume coming into the market. So in this scenario, we've got market broken outside of larger time frame acceptable value. And often what you see is price discovery. So in these kind of scenarios, when the market's kind of pushed out of an area that it's been in for a while and it's moving into new territory, or a territory that hasn't been in a while, you'll see a lot of price discovery. So, the price action is distinctly different, and you have to try and understand what that looks like on the ladder. It does change, the way the bids and the offers trade with each other. In these kind of scenarios, well, you've got very high liquidity, and there's very good flow in the market. So because there's very good flow, then we know there's institutions. Well, basically, it's the other way around. There's good flow because there's institutions. So the institutions are present in the market and they're moving size around. That's why you see liquidity. That's why, move into areas where someone might think it's a good sell. They'll come in with good volume and the buyers step in. It's very, there's good flow, good ebb, and you can read. And that's why, from a strat perspective, they very simply trade flows. And that applies to, momentum and breakouts, which we'll cover in module 7. So that's a very interesting scenario. Then we've got probably a very rare scenario, a lot, I'd say rarer than the scenarios we just covered. And that scenario, we've got high volatility, but low volume. So what we'll say here is this is it's a rare scenario, and it usually occurs when there's been a large market shock. So it occurs when there's large market shock. What do I mean by that? So basically, when you've got a market that's been, coiled for quite a while, or isn't expecting something, and then you get a massive shock, something just happens in the market, moves on very high volume, breaks out, and it just shocks people. As usually if you get like a really big downturn in the equities, and they just out of nowhere one day just completely shank, um, in the next coming days / weeks, there is good volume on some days, but some days, the algorithms are switched off and there's less paper in the market. A lot of people are kind of, not visible in the market. It's low liquidity. The market makers aren't there, and you've got just very little on the bid and offer. So there's very low liquidity conditions. The algos are switched off because there's too much risk in the market. So you get these conditions where it's just wanging around from, left and right, high volatility, but very low volume. And usually in these kind of scenarios, you want to trade them a little bit differently. So like we said, like we just mentioned, um, just bear with me for a second. So like we just mentioned, in these kind of scenarios, you've got low liquidity. Also, algos not present because there's too much risk. And the strategy that you want to employ in these kind of situations, well, it depends really on the structure of the market. It does really depend. However, you get a lot of irrational moves. So in a lot of cases, you might want to fade irrational moves. Fade irrational moves. But I will say, beware. Be aware of big size. The big size comes on the book. It's very clear on the book. Try not to fade that. That's different. If you see big size in the book and you don't step in front of it, or against it, you can go with it for a few ticks because it's very low liquidity. If a big buyer or seller has to come into the market, it can move the market, 10 to 20 ticks sometimes just because it's a big buyer or seller in the market. So bear that in mind. So these are the kind of volume and liquidity conditions that you can have in the marketplace. And it's important to understand these, like I said before, because the market's always moving from one to the other. And usually the progression that we see in the market, usually the market doesn't really spend a lot of time in this quadrant. A lot of the time it's spending in this area, which is really range bound, good volume, reasonable, average to good volume, um, and sorry, not this one here. High volume, low volatility. So the market's kind of uh, trading within an acceptable range, low volatility, not moving too much. And usually the progression that you see is, you get these really low, the market usually moves between these three. So between low volume, low volatility to, so from this, usually we move to this, and sometimes from this, we move to this, and back and forth, it'll move from area to area. And very seldomly we get into this market state, which you have to understand when it happens. Some people are not prepared for it. So this is the kind of structure we're going to build. In the next video, we're going to actually look at building a very simple model of the market, look at some auction theory and volume profiling, before we actually start looking specifically at fading and how to approach that. So stay tuned, guys.